You were at a family gathering last month. Maybe it was a cookout, maybe it was Thanksgiving dinner, and at some point, someone, a relative, an old friend, somebody's brother-in-law, leaned across the table and said it with complete confidence. Real estate is the only real wealth. Stocks are a casino. And part of you nodded because it sounded right, because you could see a house, you could touch it. It felt real in a way that a brokerage account statement never quite does. But another part of you remembered what your index fund has been doing quietly for the last 10 years. And you wondered, which one is actually right? Here is the thing. At 40 or 50, this is not an abstract debate. You do not have the luxury of making a 20-year mistake and recovering from it. You are juggling a career, possibly aging parents, your own retirement countdown. The stakes of getting this wrong are real, and most of the people arguing loudest about real estate versus stocks are not running the actual math. Today, we run the actual math. Both sides, no agenda. And at the end, I am going to give you the honest verdict. Not which one sounds better, but which one breeds more wealth for someone specifically in your situation after 40. I'm Jack. This is Midlife Money, and this one might change the way you think about where your next dollar goes. Before we get into the numbers, let me tell you what most people get wrong about this comparison. They choose based on stories. A relative who got rich flipping houses in 2004, a friend who panic sold their entire portfolio in 2020 and missed the recovery. These stories feel like evidence. They are not. They are anecdotes. And anecdotes will not fund your retirement. The real answer to this question is found in 5 specific variables that most comparisons completely ignore. And once you understand those 5 variables for your specific situation at your specific age, the answer becomes a lot clearer than the dinner table argument makes it seem. Let's start with the case for stocks. The S&P 500 has delivered an average annual return of approximately 10% over the last century. That number is not an opinion. It is one of the most studied figures in the history of personal finance. But let me make it real for you with actual numbers. Take $153,500, a realistic amount of capital for a midlife investor making a serious move. Put that into a real estate property in 1995. By 2024, that property would be worth approximately $530,000. Now, put that same $153,500 into the S&P 500 in 1995 and leave it alone. By 2024, that investment would have grown to over $3.4 million. That is not a typo. Same starting capital, same time horizon, one decision, a $2.9 million difference. Now, I know what some of you are thinking. Real estate has leverage. We will get to that in a moment. But first, let me give you the 3 advantages that make stocks uniquely powerful for the midlife investor. Advantage 1, liquidity. If you need cash in your 60s, a medical emergency, a lifestyle change, a chance to help your kids, you can sell stocks in 3 days. You cannot sell 10% of a house to pay for a surgery. When you need money in retirement, liquidity is not a minor consideration. It is survival. Advantage 2, zero management. After 40, your most valuable asset is not money. It is time. Stocks require 0 phone calls about leaking toilets at 2 in the morning, 0 weekends spent managing contractors. Advantage 3, the catch-up contribution. This one most people over 50 have never fully used. If you are 50 or older, the IRS allows you to contribute up to $31,000 per year to a 401k and $8,000 to an IRA. That is $39,000 a year growing in a tax-advantaged account. No real estate investment on earth offers a tax structure that competitive. This is a wealth accelerator built specifically for people who feel behind, and most people who qualify for it are leaving it completely unused. Now, let's talk about real estate. And specifically, let's talk about the thing that makes every real estate investor's eyes light up: leverage. Here is why leverage changes the math entirely. If you put $60,000 down on a $300,000 property, and that property appreciates at 4% per year, which is roughly the historical average for residential real estate, you did not earn 4% on your money. You earned appreciation on the full $300,000, not just your $60,000. Over 10 years, that leverage effect can produce a return on your actual capital that looks nothing like a 4% gain. That is the legitimate power of real estate, and it is real. But here is the chapter of the leverage story that most real estate advocates leave out entirely. The hidden drain. Most investors look at a $2,200 rent check and an $1,800 mortgage and think they are making $400 a month. They are running the wrong math. Here is what that calculation is actually missing. Maintenance costs roughly 1 to 2% of the property's value every year. On a $300,000 property, that is $3,000 to $6,000 annually. Vacancy runs approximately 1 month per year of zero rental income. Property taxes and insurance have risen sharply in most markets. And if you hire a property manager to handle the 2 a.m. phone calls, which you probably should after 40, add another 8 to 10% of gross rent off the top. When you run the full numbers, that headline 8% return on a rental property is often actually 4 to 6% after real costs. And there is one more cost that never appears on any spreadsheet: your time. A rental property is not a passive investment. It is a part-time job. For a 40-year-old with a career, a family, and a retirement to build, that time has a dollar value, and most real estate comparisons never assign it one. Now, here is where the conversation gets genuinely interesting, because the math alone does not decide this. In your 40s and 50s, you are entering what I think of as the magical stage of your financial life. For the first time, all three things are converging. You have money, you still have your health, but time is the one thing you cannot manufacture more of. And this convergence creates a psychological dimension to this decision that pure math cannot capture. Here is the behavioral case for real estate. The biggest problem with stocks is not the market. It is you. When the market drops 20%, and it will drop 20% again because it always has, people panic sell. They lock in the loss. They miss the recovery. You cannot panic sell a house. It takes 60 days and a realtor and closing costs. That forced discipline is not a bug. For many people, it is the feature. It is why the average homeowner has accumulated dramatically more net worth than the average renter over the same period. Not because real estate always outperforms, but because real estate forces you to stay in the game. And here is the behavioral case for stocks. Successful people in their 60s and 70s consistently say the same thing about what they wish they had done differently. They wish they had bought back their time. If you are 55 and spending your Saturdays managing a rental property to generate an extra $500 a month, you are trading the limited healthy years you have left for a wage that does not reflect what your time is actually worth. Stocks do not ask for your weekends. So what do you actually do? Here is the 5-step framework for the midlife investor. Step 1. Build your liquid base first. Before touching real estate, ensure you have at least 3 to 6 months of living expenses in a high-yield savings account. Real estate ties up capital. You need a floor before you go there. Step 2. Max the match. If your employer matches your 401k contributions, that is an instant 50 to 100% return on your money. No real estate deal on earth comes close to that. Capture the full match before any other investment decision. Step 3. Apply the $40,000 rule. If you have less than $40,000 to invest, stay in index funds. Real estate requires capital reserves for repairs, vacancies, and unexpected costs. Undercapitalized real estate investing is one of the fastest ways to lose money in midlife. Step 4. Know your purpose. If you genuinely enjoy the craft of finding deals, negotiating, renovating, and building, real estate can accelerate your path in ways that feel meaningful. If what you want is a retirement that runs itself while you live your life, low-cost target date index funds are the answer. Step 5. Consider REITs. If you want real estate exposure without the 2 a.m. phone calls, real estate investment trusts give you the income and diversification of property ownership with the liquidity of a stock. It is the middle path that most people never consider. And for the midlife investor who wants both worlds, it is worth serious attention. Here is the honest verdict. Stocks mathematically compound faster with less effort, more liquidity, and a tax-advantaged catch-up structure that was built specifically for where you are right now. Real estate builds discipline, creates leverage, and provides a psychological structure that keeps many people invested through downturns they would otherwise abandon. The richest version of you is not the one who picked the perfect asset. It is the one who picked the right asset for their specific situation and stayed in the game for 20 years without flinching.
Think of it this way. A rental property is a business. It requires capital, time, management, and a tolerance for complexity. An index fund is a passive income stream. It requires consistency, patience, and the discipline to leave it alone. Before you choose, be honest about which one you are actually willing to run. The next time someone leans across the dinner table and tells you real estate is the only real wealth, you now have the math. And the math tells a more complicated, more honest, and ultimately more useful story than either side of that argument usually admits. To make this decision personally, not just theoretically, I have put together a free real estate versus stocks decision worksheet. It walks you through the same 5 variables we covered today and applies them directly to your specific situation, your capital, your time, your liquidity needs, your behavioral profile, and your goals. 5 sections under 5 minutes. And at the end, it tells you clearly which path makes the most sense for where you are right now. The link is in the description below. Download it, print it, and fill it out before you make any moves. That one step could save you from a very expensive decision made on someone else's story instead of your own math. If this gave you a clearer picture, hit like and subscribe. I put out a new video every week built specifically for where you are right now. And drop a comment below. Are you team real estate, team stocks, or somewhere in between? I read every single one. See you next week.